Hi there, I'm Sukde. I'm a chartered accountant and an MBA. Accounting for equity investments and joint operations in group financial statements is a complex and lengthy topic. However, knowledge of this topic is always tested in professional accounting examinations. The best way to master this topic is first to get an overview of the subject area before delving into the complexities of each type of equity investment. So the purpose of this tutorial is to provide an overview of the various classifications of equity investments and how they are accounted in group accounts. Right, in this tutorial, I will discuss the recognition criteria and the measurement basis to use when reporting equity investments in group accounts. The recognition criteria involve the classification of equity investments to determine the appropriate measurement base to apply. And as the slide shows, there are effectively 4 measurement bases: the fair value method, the equity method, the acquisition method, and accounting for joint operations. Equity investments refer to the acquisition of shares in a target company by an investing company for strategic reasons rather than for trading purposes. By strategic reason, we mean that the group intends to hold the shares for a long period of time. These equity investments made by the investing company in the target company can vary from, say, 1% to 100%. When reporting equity investments and joint operations in group financial statements, there are 5 international accounting standards dealing with its recognition, measurement, and presentation principles. The main recognition criteria that determines the measurement and presentation principles is the percentage shareholding in the target company held by the group or parent company. This diagram shows the classification of equity investments and the relevant accounting standards which discuss the recognition criteria. Passive investments is where the group holds less than 20% of the shares in the target company. It is classified as passive as the parent company cannot influence the target company's financial and operational policies, however, is still a non-current asset in the group accounts. Associate investments, where the group holds between 20% and 50% of the shares in the target company. This level of shareholding allows the group company to exercise strategic influence over the associate company's financial and operational policies. Subsidiary investments, where the group holds more than 50% of the shares in the subsidiary company. This level of shareholding gives it control or power over the subsidiary company's operational and financial policies. The next classification is joint venture investments. Together with other entities or other companies in the joint venture, it exercises joint control over the joint venture company, and no one party has more than 50% shareholding in the joint venture company. The word joint controlled has a special meaning, exists only when decisions concerning strategic, operational, and financial policies require the unanimous consent of the parties sharing control. Finally, we have joint operations investments. Here the joint venture agreement sets out each joint ventures rights to the assets and obligation for the liabilities of the joint operations. For it to be classified as a joint operations, all parties in the joint agreement must exercise joint control over the joint operations. The joint operations can be conducted through a separate legal entity or managed by one of the joint operators. In this slide, I will list the various measurement bases. The measurement base is dependent on the equity investment classification. So, if an equity investment is classified as a passive investment, then the measurement base for valuation at the group's financial year end, for example, is fair value, and the fair value method is the price at the marketplace. If an equity investment is classified as an associate investment, where the parent company holds between 20 and 50% of the shares in the target company, the method of valuation is the equity method, and that is found out listed in IAS 28. For subsidiary companies, where the parent company holds more than 50% in the target company, the measurement base is the acquisition method, and again they are listed in IFRS 3 and 10. For joint venture companies, the measurement method is the equity method, and again it's listed in IAS 28. And finally, we have joint operations, which is different from joint ventures, in that the measurement base is set out in the joint venture agreement. In this slide, and the slides to follow, I will discuss each of the measurement bases in greater depth. Now, the fair value method can be either fair value through profit and loss, or fair value through other comprehensive income. In the fair value through profit and loss, in the group financial statement, the passive equity investments are valued at fair value at the financial year end, and any unrealized gains or losses are posted to the profit and loss account. Dividends are recognized in the profit and loss account. In the fair value through other comprehensive income, entity can make an irrevocable election to classify the investment at fair value through other comprehensive income, FVTOCI, on the ground that these investments are not held for trading purposes. This reduces the volatility in earnings from the profit and loss account. Equity investments are valued at fair value at the financial year end, and any unrealized gains and losses are posted to the other comprehensive income and retained earnings in the balance sheet. On the sale of these equity investments, any gains or losses on disposal are posted to the profit and loss account, but past gains and losses are not recycled to the profit and loss account. Dividends on equity investments are designated as FVOC1 are recognized in the profit and loss account. In this slide, we will have a quick preview of the fair value measurement principles. IFRS 13 sets out a fair value hierarchy, how to determine fair value of an asset or liability. As you can see from the slides, there are 3 levels, level 1, level 2, and level 3. If the equity investment represents quoted investments, then level 1 hierarchy should be used. Level 1 is unadjusted quoted prices in active markets. If the equity investment represents unquoted in shares, then level 2 should be used. And level 2 is the use of quoted prices in active market as a proxy for similar assets or liabilities. Finally, level 3 is based on data that is not observable and is used where there is no proxy quoted shares available and therefore have to depend on unobservable data such as cash flow of the entity to determine fair value. Let us look at how a UK-listed company, Brickability Group PLC, accounted for passive investments in its financial statements. As you can see, the passive investments, which I've highlighted by the blue arrow, are listed under non-current assets as investments in financial assets, and this represents a 12.5% shareholding in Lewandale Holdings Limited, which is an unquoted company. As the shareholding is less than 20% of the share capital, the measurement base for the equity investment is fair value. In the notes accompanying the balance sheet of Brickability PLC, it has elected to account for the equity investment at fair value through other comprehensive income, as it regards the shareholding to be a long-term investment. This option allows Brickability PLC to post annual unrealized gains or losses arising on the revaluation of the equity investment at the financial year end to other comprehensive income. These unrealized gains or losses will not be recycled to the profit and loss account should the investment be sold in the future. In the fair value hierarchy, which is IFRS 13, this investment has a level 2 classification as the carrying value in the balance sheet approximates to the parent company's share of the net assets of Lendon Holdings Limited, and that as it is an observable data. The equity method is used to value equity investments which are classified as associate companies and joint venture companies. You will recall that in an associate company, the parent company owns between 20% and 50% shares in the target company. In a joint venture, the joint ventures together control more than 50% of the target company, and there is joint control. Each joint venture will use the equity method for its equity holding in the target company. The equity method is also described as a partial consolidation method, as it incorporates in the group income statement the parent company's share of the post-acquisition profit after tax of the associate and joint venture rather than the dividends received from the associate and joint venture companies. The rationale for the use of the equity method of accounting in associates and joint venture companies is the substance over form argument. The parent company exercises strategic influence over the associate and joint venturer, and therefore a share of the net assets is a more appropriate valuation method than just the fair value of the shares held. So, what are the measurement principles of the equity method of accounting? The group consolidated income statement or profit and loss account reflects the group's share of the associate and joint ventures post-acquisition after-tax profit and not dividends received. In the consolidated balance sheet, the investment in the associate and joint venture is initially recognized at cost. This is then adjusted by the group share of post-acquisition profit of the associate and joint venture company, less dividends received. Next is the reconciliation, and we'll look at it in the next slide. The final step in the equity accounting method is the reconciliation process. The carrying amount of the associate and joint venture investments in the consolidated balance sheets are reconciled to the group share of the net assets of the associate and joint venture companies since the acquisition date. In this diagram, as you start off with the carrying value of in the group balance sheet at year-end of the associate and joint ventures, and we deduct from it the group share of the net assets of the associate and joint ventures, and the difference represents goodwill. The reconciliation appears as a note in the balance sheet, and its purpose is to ascertain the amount of goodwill, if any, included in the carrying amount of the investments. Goodwill, you will recall, is the excess of the purchase price over the group share of the net assets of the associates and joint ventures acquired. We will now look at how a UK public listed company, Dominion Pizza Group plc, incorporates an associate company in its group financial statement. We should recall that a company is classified as an associate company where the parent company holds between 20 and 50% of the shares in that company. In Dominion Pizza Group plc, in the annual report for year ended 26 December 2021, it had 3 associate companies. A 49% interest in Full House Restaurant Holdings Limited. This is a private company that manages pizza delivery stores in the UK. This acquisition was made in prior years. A 33.3% interest in Daytona JV Limited, also a UK private company, and this acquisition was made in prior years. And a 46% interest in Victor DP Limited, which was acquired for a cash consideration of 6.6 million, and this acquisition was made on the 20th of December 2021. The group's share of the associated post-after-tax acquisition profit of the associate companies in 2021 was 9.9 million. And finally, we have the net assets of the associate companies on 26th of December 2021, shown in the table attached. So, our task here is to show how the associates' accounting data has been incorporated in Dominion Pizza Group's plc consolidated financial statement for the year ended 26th of December 2021. Here we have the case study, which is Dominion Pizza Group plc, which has 3 associates, and we show how these 3 associates are incorporated in the consolidated financial statements for the year ended 26th of December 2021. As you can see, the group share of the associate post-after-tax acquisition profit of the associate companies was 9.9 million, and this is shown after the operating profit or loss, and the contra entry of this share of the associate profit is added to the investment in associates shown in the group balance sheet. In this slide, we look at how the associates information is shown in the balance sheet. If you look under the group balance sheet, you'll find under non-current assets an item called investment in associates of 48 million. And let's see how this figure has been made up. We start with the opening balance. which is 35.3 million. We add the cost of new acquisitions in the current financial year in December 2021 of Victor, which is a non-UK company, so 6.6 million. We have the share of the associates' profit for the period, which is 9.9 million. We take away from that the dividends received from the associates, which was 2.2 million. And finally, we have foreign exchange movements, because the fact that one of the associates was a non-UK company. We have 1.6 million. And finally, we have the balance at the end of year end, which is 48 million. Under our IFRS 12, a reconciliation is required. The carrying amount of the associate investments in the consolidated balance sheet is reconciled with the group share of the net assets of the associates. In the diagram attached, you can see the associate net assets at 26th of December. For Full House, it is 20.8 million. For Daytons, it's 80.7 million. And for Victor, it is 14.4 million. The group share, which is represented by the respective percentages of 49, 33.3 and 46%, and that works out for each for Full House 10.2 million, 26.9 million and 6.6 million. You then have the carrying amount of investments in the associates balance sheet, which is 12.5, 28.9 and 6.6, and the difference between the group share of the net assets and the carrying amount represents goodwill, and that is 2.3 for Full House. Daytons it's 2 million, and for VIX it's nothing, simply because it was acquired on the 20th of December 2021. The reconciliation provides users with useful information about the associates' net assets, and more importantly, if there's any amount of goodwill included in the carrying amount of the investment in associates shown in the group consolidated balance sheet. This reconciliation appears as a note in the balance sheet. The acquisition method is used for companies classified as subsidiary companies. The subsidiary classification are for companies where the parent or investing company has more than 50% of the shares in the target company. In this scenario, the parent company controls or has power over the subsidiary company's strategic, financial, and operational policies. The acquisition method is also known as the full consolidation method, i.e. all the revenues, expenses, assets, and liabilities of the subsidiary company are combined line by line with their respective numbers in the financial statements of the parent company to present a group financial consolidated statement. The acquisition method, or the full consolidation method, is based on the substance of a form argument. As the group controls the subsidiary, they are in reality one entity and hence the full consolidation of their respective financial statements. Let's look at the measurement principles involved in the acquisition method. The first step in the consolidation process is to open up a goodwill account in the parent company's books on the acquisition date. Let's look at the entries in the goodwill account. The first entry is the purchase consideration paid by the parent company. The purchase consideration will include any contingent consideration recognized at fair value at the acquisition date. The determination of the fair value is based on discounted cash flow. We add to the purchase consideration the non-controlling interest. As you will remember, the non-controlling interest refers to the percentage of the shares in the subsidiary not held by the investor or parent company. The percentage of the shares held by the non-controlling interest can be measured either at the fair value of the shares, which is the market value of the shares, or at the NCI's percentage share of the subsidiary's identifiable fair value of the net assets. The choice of measurement basis is made on an acquisition by acquisition basis. We take away from those two the fair value of the net assets. Now, any changes in the fair value of the net assets 1 year from the date of acquisition will impact on the goodwill balance and treated as a prior year adjustment. So goodwill arises where the purchase consideration and the non-controlling interest exceeds the fair value of the assets and liabilities acquired in of the target company and is shown as a non-current asset in the group balance sheet. In some acquisitions where the fair value of the net assets acquired exceeds the purchase consideration in NCI, there is a gain on purchase, sometimes called bargain purchase. This gain is recognized in the group profit and loss account. Finally, acquisition-related costs incurred are expensed to the group profit and loss account. We will now look at how a UK public listed company calculated goodwill when it acquired a controlling stake in a target company. Case study Evolution Group plc. On the 17th of December 2020, in line with its strategy of expanding into new markets, it acquired a controlling interest of 75% of the issued share capital of Kleinrad Holding BV, a company based in the Netherlands, for £37.067 million. Attached is the book value of the fair value of the net assets of this company on 17th of December. If you look at it, I've highlighted something in red where it shows you the total identifiable net assets, and you have the book value at the date of acquisition, which is £4.815 million. And the fair value adjustment is £17,005.97 million, with a total fair value of the net assets at £22.412 million. If we look at these adjustments, a big adjustment is in intangible assets. You can see that it's to the value of £21.554 million. Intangible assets acquired in a business are identified and recognized separately from goodwill, and they include software costs, customer base, and trademarks. Both Kleinrad and Evolution plc have a financial year end which ends on the 31st of July every year, in this case 2021. Now, in calculating the 25% non-controlling interest, Evolution plc used the proportionate share of the subsidiary's identifiable net assets in accordance with IFRS 3. So the case here is to show how the goodwill amount has been calculated on the 17th of December 2020. So our task is to write up the goodwill account. The first entry you make is the purchase consideration, which in the question was 37.067 million. The next step is to calculate the non-controlling interest amount, and the non-controlling percentage share is 25% of the fair value, which is 22.412 million, which gives us a figure of 5.603 million. So just to show the calculation again, 25% of the net assets gives us 5.603. We add the notional non-controlling interest of 5.603 million to the purchase consideration to arrive at the fair value of Clamrad on 17th of December 2020 of 42.670 million. We then take away or deduct the fair value of the identifiable net assets on the 17th of December 2020, which is the figure given 22,412, to arrive at the excess of the purchase consideration over the net assets, which gives us a figure of 20,258,000. So that 20,258,000 represents the goodwill balance, which is the excess of the purchase consideration over the fair value of the identifiable net assets. This will appear as a non-current assets in the consolidated balance sheet of Volution plc at 31st of July 2021. Finally, we look at accounting for joint operations, which are different from joint ventures. Joint arrangements are common in the energy sector, where the exploration, development of production of oil and gas requires complex skill sets. The basic joint arrangement agreement will provide for each joint operator to provide assets or a service to a project in addition to contributing any additional assets used in the project. The income that each joint operator receives is usually a percentage share of the expenses and income of the project. Recognition. In a joint operation, the group shares joint control primarily via contractual agreements with other parties. The joint operations can be managed separately by legal entity, but it is the contractual agreement between the joint operators that defines each joint operator's rights to the assets and obligation for its liabilities. Measurement. As we said earlier, the contractual agreement defines the joint operator's right to the assets and obligations for the liabilities of the joint operations. A joint operator accounts in its own financial statements for its interest in a joint operation by recognizing its own assets and its share of any assets held jointly, its own liabilities and its share of any liabilities incurred jointly, its share of the revenue from the sale of any output by the joint operation, and its own expenses and its share of any expenses incurred jointly. Here we look at a case study. How do we account for joint operations? XYZ Limited owns a 25% share in a manufacturing facility operation which has a total construction cost of 200 million and was completed and ready for use on 1st of April 2020. The facility is expected to have a useful life of 20 years. All economic decisions concerning the facility require the unanimous consent of XYZ and 2 other investors who own the remaining 75%. Revenues earned from the facility for the period ended 31st of December 2020, which is also the year end of XYZ Limited, was 57 million. Production costs for goods sold and other operating costs were 36 million. XYZ has not made any accounting entries for the year ended 31st of December 2020 in relation to the facility except for the 50 million construction cost included within property, plant and equipment. It has been agreed that the profit and loss should be split evenly across the 3 investors. Required, show the journal entries to reflect the above transactions in the financial statements of XYZ Limited for the year ended 31st of December 2020. Before we start looking at the journal entries, please note that the manufacturing facility is a joint operation, as a joint agreement stipulates that XYZ Limited contributes 25% towards the cost of the manufacturing facility, but receives only 1/3 of the share of the output of the joint operations. So start off with the 50 million. That's already been, if you like, accounted for in its own accounts. What we have to provide here is the depreciation on that 50 million, which is to divide the 50 million by the 20 years and take 9/12 because the operation was ready for use from April 2020. That gives us a figure of 1.9 million, and in income statement we would show as an operation cost of 1.9 million. The operating costs is given as 36 million. Each investor has to share 1/3 of the cost, so that is 36 divided by 3 gives us 12. And as we haven't paid for this, we have a current liability in the balance sheet of XYZ of 12 million. The next one is the revenue from joint operations. The total of that is 57 million, and XYZ share of 1/3 gives us 19 million. Again, this has not been received, and it will show up as a current asset in XYZ Limited of 19 million. And that's how we do the journal entries.